Why did the stock market crash in 1929? The Roaring Twenties, a decade of unprecedented prosperity and economic growth in America. But in October of 1929, it all came crashing down. The stock market collapse that followed would usher in the Great Depression, forever changing the course of America and world history. Welcome to our channel, folks. I'm Dave Seymour. Today we're diving into one of the most pivotal events in economic history, the stock market crash of 1929. The story of 1929 stock market crash is more than just the numbers on a ticker tape. It is a tale of human ambition, fear, and the delicate balance of an entire economic system. But to understand why it happened, we need to look beyond that fateful day in October. We need to journey back to the roots of this crisis, the decade that preceded it. The 1920s in America, well, they were a time of remarkable change and growth. But beneath the glittering surface, cracks began forming in the foundation of the American dream. World War I had ended, leaving the United States as the world's leading economic power. Factories that once produced tanks and ammunition now churn out consumer goods at an astonishing rate. New technologies like the automobile, radio, and household appliances were transforming daily life. The assembly line, pioneered by Henry Ford, has revolutionized manufacturing. But who's buying all these new products? Enter the American consumer, armed with a powerful new tool: credit. For the first time in history, ordinary people could buy now and pay later. Refrigerators, automobiles, and radios, luxuries once reserved for the wealthy, were now within the reach of the middle class. It seemed like a win-win situation. Consumers got the goods they desired, and businesses saw their profits soar. But what happens when people start viewing debt not as a temporary means to an end, but as a way of life? Well, as consumer spending fueled economic growth, another phenomenon was taking shape on Wall Street. Yeah, the stock market. Once the playground of the rich, was opening its doors to a new class of investors. Imagine, if you will, a modest bank clerk named John. He's heard whispers of fortunes being made overnight in the stock market. With dreams of wealth dancing in his head, John takes his life savings and buys shares in a promising automobile company. Now, to his delight, the stock's value doubles in just a few months. John is hooked. He tells his friends, who tell their friends, and soon it seems like everyone is playing the markets. However, many of these new investors, like John, didn't fully understand the risks they were taking. They saw the stock market as a one-way ticket to riches, not realizing that what goes up must eventually and will come down. This brings us to our next question. What happens when speculation replaces informed investment? When the promise of easy money blinds people to the fundamental value of what they're buying? As we move deeper into the 1920s, another player enters our drama: the banks. Swept up in the euphoria of the bull market, many banks began engaging in risky practices. Picture a small town bank in Iowa. Seeing the booming stock market, the manager decides to invest the bank's funds in stocks, hoping for higher returns. It's a gamble, but with stocks consistently rising, seems like a pretty safe bet. The bank wasn't alone. Across the country, financial institutions were becoming increasingly intertwined with the stock market. They weren't just holding people's savings anymore. They were active players in a speculative frenzy. Now let's connect the dots. We have consumers taking on more debt than ever before, a stock market inflated by inexperienced investors, and banks putting their depositors' money at risk. It's a recipe for disaster. But in the intoxicating atmosphere of the Roaring Twenties, few could see the danger ahead. As we approach this fateful year of 1929, let's zoom out and take a look at the bigger picture. The US economy was booming, but it wasn't a balanced kind of growth. While the wealthy were getting richer, thanks in large part to their stock market gains, the average worker's wages weren't keeping pace. This disparity created a problem. The people who were supposed to be buying all these consumer goods couldn't afford to keep up with the increasing production. Companies began to see their inventories pile up, but few recognized this as a warning sign. In an economy driven by consumer spending, what happens when consumers can no longer spend? Well, now let's turn our attention to the Federal Reserve, the central bank of the United States. In the late 1920s, the Feds were faced with a dilemma. On one hand, the soaring stock market showed signs of becoming a dangerous bubble. And on the other hand, taking action to curb speculation could potentially trigger a recession. In 1928 and 1929, the Fed chose to raise interest rates, hoping to cool down the overheated economy. But like a doctor prescribing a strong medicine without fully understanding the patient's condition, this action would have unintended consequences. A perfect storm is brewing, but everything still looks rosy on the surface. The Dow Jones Industrial Average peaked on September the 3rd, 1929, closing at 381.17. No one knows it yet, but the bubble is about to burst. October the 24th, 1929, Black Thursday, the day the music stopped. On the floor of the New York Stock Exchange, the opening bell rings, and almost immediately an avalanche of sell orders floods in. Panic spreads like wildfire. By the end of the day, a record 12.9 million shares has been traded, and the Dow had fallen 11%. But this is just the beginning. The following Monday, October the 28th, the market fell another 13%. Then comes Black Tuesday, October the 29th. In a single day, the market closes and loses 12% of its value, and billions of dollars vanish into thin air. Now remember John, our bank clerk turned amateur investor? In a matter of days, he's lost everything. Absolutely everything. His life savings are gone, and his dreams of wealth are shattered. Multiply John's story by millions and you begin to grasp the scale of the devastation. But why did it happen? Why did the market crash with such spectacular force? Well, the truth is there isn't or wasn't any single cause, but rather a confluence of factors that created a perfect economic storm. Many investors had been buying stocks on margin, meaning they only put down a fraction of the stock's value and they borrowed the rest. Think of it like buying $1,000 worth of stocks for only $100 while your broker covers the rest. When stock prices started to fall, these investors were hit with margin calls, forcing them to sell their stocks to cover their loans. This created a vicious cycle of selling, driving prices down even further. Then there was the role of the banks. Remember how they had invested heavily in the stock market? As stock prices plummeted, so did the value of their assets. Suddenly, banks found themselves on shaky ground, and many wouldn't survive the crash. The Federal Reserve, which had hoped to gently deflate the bubble, now faced a full-blown crisis. Its earlier interest rate hikes intended to cool speculation had instead helped trigger a massive liquidity crunch. As news of the crash spread, fear gripped nations and markets throughout the world. People rushed to banks to withdraw their savings, creating runs on banks across the country. Many banks, their assets tied up in now worthless stocks, well, they couldn't meet the demand. Thousands would ultimately fail, taking their depositors' savings with them. The stock market crash of 1929 marked the beginning of the Great Depression, a period of economic hardship that would last for more than a decade. Unemployment soared, reaching 25% at its peak. Industrial production plummeted. The American dream, so vibrant just a few years earlier, now seemed like a cruel joke. The effects weren't limited to the United States. The crash sent shockwaves through the global economy. Countries that depended on American loans and trade saw their own economies collapse. The interconnected nature of the global financial system, which had seemed like an asset during the boom years, now ensured that no country was spared from the fallout. As we look back on the events of 1929, it's natural to ask, well, could it happen again? The truth is, while we've learned many lessons from the crash and the Great Depression that followed, the fundamental human behaviors that drove this crisis, greed, fear, the tendency to follow the crowd, well, they remain unchanged. In the aftermath of the crash, sweeping reforms were introduced to prevent a similar catastrophe. The Glass-Steagall Act separated commercial and investment banking. The Securities and Exchange Commission was created to regulate the stock market. The Federal Deposit Insurance Corporation was established to protect bank depositors. These measures helped to stabilize the financial system and restore confidence. But as the memory of the crash faded, so too did some of the caution it had instilled. Fast forward to early 21st century. Once again, we saw a period of rapid economic growth fueled by technologies and financial innovations. Once again, we saw a real estate bubble, risky lending practices, and a stock market that seemed to only go in one direction, and that was up. And in 2008, we saw another financial crisis unfold with eerie echoes of 1929. So what lessons can we draw from the crash of 1929? Well, perhaps the most important is the need for vigilance. Economic bubbles can form even in the most sophisticated financial systems. The challenge is recognizing them before they burst. We've also learned the importance of regulation in maintaining economic stability. The reforms introduced after 1929 helped to create decades of relative financial calm. However, as regulations gradually loosened in the late 20th century, some of the old vulnerabilities reemerged. Finally, the crash of 1929 teaches us about the dangers of inequality. When the benefits of economic growth are concentrated at the top, it can create instability in the entire system. A healthy economy needs a broad base of consumers with the means to participate fully in economic life. While we have more tools and knowledge to prevent and mitigate economic crises, we can never entirely eliminate the risk. The economy, after all, is not just a set of numbers and policies. It's a complex system driven by human behavior with all of its rationality and irrationality. We can remain alert to the signs of trouble, strive for a more equitable distribution of economic gains, and support sensible regulations that protect against the worst excesses of speculation and risk-taking. Perhaps most importantly, we can remember the lessons of 1929, because understanding our past gives us the wisdom to shape a better future. Well, that's all for today. Thanks for sticking around for this deep dive. If you found this video insightful, please give it a thumbs up and subscribe to our channel for more deep dives into economic history and its relevance today. And don't forget to hit that notification bell to stay updated on our latest uploads. Until next time, stay curious and stay informed.